folks, Scott here, and this is the wrap for Tuesday, September 24th. So this is a daily chart of the S&P 500, and you can see the last four candlesticks have all been red. That means they closed lower than they opened. That's a somewhat unusual pattern, four consecutive ones in a row when above a 200-day moving average. Just eyeballing it, it looks like the last time this happened was back in June. 1, 2, 3, 4, and that marked the bottom. Now I'm not saying by any means that this is the bottom. I don't know. That's not my expertise. But I do want to show you the results of fading gaps after four consecutive red candlesticks in the S&P 500. Now I'll use Gap Trader, my back testing tool, which we will be demoing extensively along with Range Trader on Wednesday, which is tomorrow. So be sure to sign up if you have not already. I'll show you where to do that in just a moment on our website. And drum roll, there you go. So two things stand out significantly here to me. One, odds are 2 to 1 of gapping up following, at least based on history, 2 to 1 following four consecutive red candlesticks. See that? 33 short trades. That means you short up gaps, you buy down gaps, the way my system is set up. So 2 to 1 odds of gapping up, and they've been pretty good average gaps. Well, at least the winners have averaged almost 5 points. So market is compressed to the downside. During a bull market, could get a decent pop tomorrow is what this tells me. Secondly, if we do, odds of me shorting it with a full gap size are extremely low, if not nil. Why? Because using an end of day stop, it's only a 48% historical winner versus the normal 70% winner for most gaps. And it's lost a bunch of money using an end of day stop also. It lost twice as much as it's made. Now I will rerun these numbers using our MTG stop parameters, which will probably make these losses be a lot smaller and improve the profit factor, because we'll get rid of this monster 28-point loser here. Just take these numbers, divide by 500. By the way, that's the technique for 10 contracts, $50 a point. But still, it's probably going to be significantly negative. So, and we know win rate at most can be what? 48.4%. Because using intraday stop, if you're lucky, once in a blue moon, you'll be able to capture all the winning trades historically. Most of the time, you'll see a degradation, a lower win rate here. So looks to be very risky for shorting and just neutral for buying down gaps. Market's a little bit unstable. And I tell you, based upon where we closed, we're right in that range pre-Fed announcements. So my gut tells me this thing's going to go higher, but who knows? That my gut's worthless. All I know is if we break out of this range, it's probably a reasonable swing trade, and I'm not a swing trader. But we'll probably go test the highs up here towards the end of the month, the beginning of next month. Or break down, and who knows, let me see, where would we go? At least test the 50-day moving average and fill this gap for sure, and possibly this one too. So we shall see. Interesting times indeed. All right, at Master the Gap, sign up here for tomorrow's event. It will be stellar. See if I can get it to pop up. We're demoing both of our systems, and we'll educate you on system trading. Every year is different for me. I've always traded a mechanical system on the side. Some years it beats my probability-based trading. Some years I beat it. This happens to be a year where it is trouncing me, which frankly I'm not proud of, because members here at Master the Gap pay me to make my calls in part and help guide them in the decision making on the probability trades. But it hasn't been my best year. I'm doing okay. I'm up. And the year's not over, but mechanical system has been slaying it. So you can learn more about how I've set that up and how I teach other people to do the same tomorrow. All right, let's look at our gap guides. Actually, let me look at the worksheet first. So going in today, I thought we might end up with a gap down, but we ended up gaps up across the board, and the worksheet doesn't tell you a whole lot after a down day, because the this area here between the high and the close is really two zones, the DOC zone and the DHO zone. You'll have to look at the gap zone map on our home page to we're here in the member resources area to get that straight in your head. But it was just sort of a neutral to slightly attractive setup overall, and we had actually a risk factor, I'd call it, fading an unfilled down gap. It's certainly no edge. 55% win rate using MTG stock parameters and dead break even during bullish market. So pretty much fading gaps after an unfilled down gap is going to be a good thing in most market scenarios. just not this one. So let me show you my pre-market comments. Last night's wrap I showed after a 5-day low close, but not a 10-day low close. That was also neutral at best for up gaps. That wasn't too swift. And then my beloved cowboy gap, a unique setup that I talked about in our members download area. If you're interested, whenever I use terms you're maybe not familiar with, it's normally can be found in all of us educational information that we have for our members. But our member download area, I've done entire articles on the cowboy gap, and it's a great setup, except when you're in a bullish market. A raging bullish market, which technically we still are. We actually closed above the 10-day moving average yesterday and above the 200. I'm talking about the cash indices, that's what I use. And it's been a money loser historically. So a couple of risk factors there. Overall, you had these muted guides that really didn't look too swift for the zone. We had closing variance was huge, but what I mean by that is there was 95 over 2 points of difference, but almost 3 points of difference between where the ES closed at 4 p.m. or where it was trading at 4 p.m., which is where the ETFs closed, the Spider, for example, versus where it actually closed because it sold off. So open with some mixed directions, muted guides, closing variance issue, some neutral to risk factors here. Just nothing compelling here. So no fade for me. Discipline's the name of this game, and ended up missing a winner. Technically, right? So the gap was here, 94.75, actually inside the 4 p.m. close. See, that was over here. So the ETFs opened down, sold off. I'm not sure you would have gotten filled for a winner, but basically opened flat, sold off, filled the gap, and then some. Now here's where it gets interesting for the day. See, the price action went below 1689.50, but it stopped 2 points. This is one of the greatest tips I can give you, and it's a simple one. Unless the market's extremely volatile, I like to apply a 2-point boundary to any key level. And if prices stay within that 2-point boundary, I do not consider it to have been violated. And I talked about this as it was going on this morning, that just because we're below the lows doesn't mean it's not going to potentially reverse. The bulls have loved to do that all year. And this Chaikin volume spike here, unusually high volume, it's a free indicator on our website for members, indicated possible exhaustion. Sure enough, the market reversed. Now, I didn't get long there. Didn't have any data. 15-minute guides are pretty muted. First hour guides came out, and this, I'd already said that I was very interested in the long side. We were rallying pretty hard at this point, and we had more volume come in here. I did not think that was exhaustion. I thought it was a little bit of short covering, but some real buying also, because I too was waiting for confirmation for a possible bottom, right? We've been selling off for several days during this bull market. Getting back above the close would be bullish. And I actually did a discretionary trade long here, even before the first hour guides came out, just above. If I tried to get filled one tick above, didn't get filled, so I went ahead and chased a little bit, actually, just being honest, 93.50. Why would I chase? Because I could use a 3-point stop and get it to where? At 93.50, got it to 90.5. Right at the 2-point window below gap fill. So I thought it was unlikely after this bullish reversal markets would trade back down and stop me out. If they did, then I was just probably wrong on the trade. So went long, discretionary trade, scaled out +3, and my target was this confluence area up here. We had the open and the prior high around 1700. So I actually got out at 1699.75 for +6.25 points on that half. So it was a sweet trade. But let me show you why it was interesting. Because it was confusing today. I actually went a little bit against our guides. It didn't break my rules. I'm looking for at least 6 out of 8 to meet my criteria for a trade. But so look at the high fade today. It leans that way. It doesn't quite meet my criteria. I'm looking for 55 and 1.1, but I gave it a half a check mark. Dow futures definitely favored the high fade. Nasdaq definitely favored the high fade. Russell definitely favored the high fade, even though it had some positives for the breakout too. Looking at the ETFs, Spider favored the high fade. Diamond's right at it. Did not meet it in the Qs and did not meet it in the Russell. So I had that as being, 4.5 or 5.5 check marks out of 8. Not quite good enough, but definitely favoring the high fade. But let me tell you what I didn't like about the high fade and why I did not put it on. And I was already long. But that isn't, that was a discretionary trade. It didn't preclude me from getting short in another account. And if it meets my criteria, I'll do that. But with those slightly weaker range guides that I wanted, I had other concerns. First and foremost, the gap guides in the data overall was a little bit neutral for me. It wasn't a compelling setup for shorting. It had already filled. That had worked, but even when it fills, often it'll tell those will reverse. Those ones that are a little bit neutral that maybe you don't expect to fill, when they fill, that's one of my favorite fade to fill setups because there's often bullish pressures in place. So that was in the back of my mind. Our advanced studies which are available on our website for the first hour guides clearly showed multiple risk for the big picture for the high fade, and they favored the high breakout, so they had a bullish bias. My closing guides, which you would not have known this, or members would have known it, but closing guides, which I'm working on, which will be available soon at no additional charge, soon meaning probably 2 or 3 weeks still, they strongly favored closing higher. Now that did not happen today, but again, anytime you have numbers favoring a directional move, a directional close, you probably have some bullish pressures in play. And then the price actions I just mentioned. We had the fake out below the prior lows, sucked in some shorts, caught some momentum, got back above the close. So it just all lined up too well to favor the long side and to overlook the bias for the range guides. Now, one last reminder, one of the reasons we're creating these closing guides, which will be available soon, is to make up for a limitation of our range guides. Our range guides are primarily short-term technical indicators. Short-term, unlike my gap guides and my worksheet, which have lots of big picture data involved, bigger time frames, the closing guides, as we set them up, was really, rightly or wrongly, was set up to be more short-term and technical in nature. So that's why I tend to use a little bit more discretion on those. And today was an example where my experience and judgment in pulling it all together made a difference, and I think helped out some folks in our trading room as well. So there you go. That was my day, and that is the wrap for Tuesday, September 24th. Have a good one.